You've been making your mortgage payment every single month. You've watched your equity grow. You tell yourself it's an investment, and then you open your phone, see what the stock market did last year, and feel a version of a question you can't quite shake. Did I pick the wrong thing? You're not reckless. You're not uninformed. You made the decision millions of people make. Put your money into something real, something you can touch, something that can't go to zero overnight. And yet, there's this quiet doubt that maybe the people investing in the market are building wealth faster, that the house you're so proud of might actually be holding you back. That doubt isn't stupidity. It's the beginning of a question worth answering properly. And by the end of this, you'll have the real answer, not the one the internet gives you, but the one that's actually true for you. Picture this. It's 1985. Your parents, through every decision they ever made, every conversation overheard at the dinner table, taught you the most important financial lesson of their generation. Buy a house. The deal was clear, simple, unquestioned. Work hard, save your down payment, get your mortgage, build equity. The house goes up. You sell, you retire. That was the entire plan. And for an entire generation, it worked. Then 2008 happened. People who did everything right, made every payment, bought in solid neighborhoods, played by every rule, watched their home value collapse. 30%, 40%, sometimes 50%. Equity they'd spent years building. Gone in months. Then, the stock market spent the next decade doing something nobody's parents ever prepared them for. Going up, almost constantly. Index fund investors who did nothing, just put money in every month and looked away, quietly doubled, tripled, quadrupled their money. And the homeowner looked at their mortgage statement and felt something unfamiliar, left behind. That's not jealousy. That's what happens when you watch two different strategies play out in real time, and you're not sure anymore which story you're in. Here's something that surprises people when they actually look at the real numbers. When most people compare home equity to stock market returns, they are comparing the wrong things entirely. They see the stock market return 10% per year on average and assume their home should be judged by the same ruler. But it can't be. Your home has property taxes, maintenance, insurance, and when you sell, transaction costs that typically eat 5 to 8% of the entire sale price, gone in a weekend. When you account for all of it, most homes appreciate at roughly 3 to 4% annually in real terms. The stock market historically returns 7 to 10% after inflation. On paper, the math isn't even close. But here is what the math doesn't show. Most people who invested heavily in stocks during 2020 and 2022 also panic sold during the drops. They didn't get the 10% average. They got in at the high, sold at the low, and called it investing. The strategy that wins on paper only wins if you can actually live it. And that is where this conversation gets honest. Because this debate doesn't produce one kind of person, it produces two. And they are both convinced the other one is making a mistake. Type 1 is the equity builder. They make extra principal payments. They calculate, more than once, how much faster they'd be mortgage-free if they rounded up by $200 a month. Their home equity is the number they're most proud of on their entire net worth statement. And they'll tell you, with complete sincerity, that owning their home free and clear is the only retirement plan that actually feels real. The problem? Most of their wealth is locked inside four walls they cannot access without selling, borrowing, or going through a process that takes months and costs thousands. It's not liquid, it's not flexible, and in a real emergency, equity doesn't pay bills. Cash does. Type 2 is the market maximalist. They think paying off a mortgage early is one of the worst financial decisions a person can make. Why pay down a 4% loan when the market returns 10? They invest every spare dollar. They have strong opinions about index funds versus individual stocks. And in a bull market, they look like geniuses. Then a real crash comes, 40% down, lasting 18 months. And everything that looked like discipline turns out to have been confidence. Confidence borrowed from a market that had only gone up. They sell at the worst moment. Or they don't sell, but they can't sleep. Or they stop contributing right when it matters most. The theoretical 10% return was always conditional on something nobody warned them about: their own behavior under pressure. Here's the truth. Neither of these people is wrong. They're just operating from different psychological blueprints, built by different experiences, different fears, different definitions of the word safe. And neither of them ever asked the one question that would have changed everything. Let's be honest about what each path actually cost you. Not on the spreadsheet, in your life. Home equity costs you liquidity. The money is there, but you can't reach it without selling, borrowing against it, or spending months in a process that costs thousands. It costs you flexibility. If your city stops working for you, the job market shifts, the neighborhood changes, your life changes, the asset you've built doesn't move with you easily, and it costs you diversification. When most of your net worth is in one property at one address, you're not invested in the economy. You're invested in a single zip code. The stock market costs you something harder to measure. It costs you sleep. It costs you the ability to watch your account lose 30% and do absolutely nothing. It costs you discipline in moments that feel like emergencies. And here is what the personal finance world doesn't say loudly enough. Most people do not actually have that discipline, and there is no shame in knowing that about yourself. Here's the cruel irony buried inside this entire debate. The safer choice, building equity, paying down the mortgage, owning something real, can quietly trap you in an illiquid asset at exactly the moment you need flexibility most. And the riskier choice, investing in stocks, chasing higher returns, playing the long game, requires a level of emotional discipline that the anxiety driving you towards safety in the first place makes almost impossible to hold. You chose safety because you're afraid of losing. But the stock market punishes fear more than almost anything else. You saved for a secure future, but the strategy you chose to feel safe may be the very reason it still doesn't feel secure. Here's what I want to leave you with. The question was never home equity versus stock market. That framing was always the wrong fight. The math on the stock market is real. The math on the hidden costs of homeownership is also real, but neither number matters if the strategy doesn't survive contact with your actual life. The best investment is not the one with the highest theoretical return. It's the one you'll hold when everything in you is screaming to sell. It's the one you won't panic out of in a bad month. It's the one that lets you sleep at night. Not because the number is safe, but because you actually understand what you own and why you own it. If you've built equity and it gives you genuine security, that is not a mistake. That security has a real value that does not appear in any compound interest calculator. If you've invested in the market and held through every drop without selling, you're not just an investor. You're the rare person who understood that the return was never just about the market. It was about you. And if you've done both, some equity, some market, some flexibility, some growth, you didn't split the difference. You built a strategy that can survive more than one version of the future. Stop asking which one is better. Start asking which one you'll actually hold. Because in the end, that is the only return that matters. Drop a comment. Are you an equity builder, a market maximalist, or somewhere in between? And has anything in this video shifted how you see that choice? And if someone in your life keeps asking why you chose your house over the market, or your portfolio over your mortgage, send them this, because now they'll understand what you were actually thinking.